Hey everyone, welcome back to Dollars and Cents, where we want everyone to become more wise in the world of finance. Today we're diving into something that's making waves across global markets: China's recent stimulus package. Normally, when a country like China announces a stimulus plan, we expect markets to surge, but this time things aren't going as expected. Right now the markets are holding steady, but there's growing concern that instead of the usual growth, this stimulus could actually spark a downturn. So, what's going on? In today's video I'll break down why China's stimulus would usually boost markets, why it might have the opposite effect this time, and how it could impact the United States, and more importantly, you. Let's jump in. Okay, so first things first, what exactly is a stimulus package? In basic terms, it's when a government pumps money into its economy to stimulate growth. This can involve anything from tax cuts to direct spending on infrastructure projects, or in China's case, massive investments in their industrial and tech sectors. So why does this usually boost markets? Well, when a country like China, the second largest economy in the world, announces a stimulus package, investors get excited. Why? Because more government spending typically means more business for companies, more jobs, and ultimately, higher profits. This leads to greater confidence, and investors start buying more stocks, driving up market prices. In short, stimulus means growth, and growth means market optimism. But this time, things are a little different. So why isn't China's stimulus causing the usual excitement? Why are some experts even saying it could lead to a downturn? There are a few reasons for that. First off, China's economy has been dealing with some deep-rooted issues: sluggish consumer demand, a housing market that's facing major crises, and, most importantly, massive debt. A lot of the stimulus money is going towards bailing out failing sectors like real estate, which is in a bubble right now. Instead of driving growth, the stimulus might just be delaying the inevitable correction. Investors see this and start worrying that China's economy could be teetering on the edge of a deeper slowdown. Another reason is China's struggle with its zero-COVID policy and its impact on production and consumption. While they're moving away from that strategy, it's still left a big dent in consumer confidence. If people aren't spending, businesses aren't growing, and the economy doesn't get the boost it needs. So what we're seeing is more of a band-aid fix, where the government's stimulus is patching up immediate problems but not addressing the underlying economic slowdown. And when investors lose confidence in China's ability to sustain growth, they start pulling out, which can trigger a global market downturn. Alright, so you might be wondering, how does this all affect me here in the US or elsewhere? Well, China isn't just any economy, it's a huge player on the global stage. A slowdown in China can ripple through markets worldwide. The US and other countries rely on China for manufacturing, raw materials, and as a major trading partner. If China's economy stumbles, it can cause supply chain issues, leading to higher costs for everything from electronics to clothing. If you've noticed prices going up for everyday items, part of that could be traced back to economic instability in China. Additionally, when investors pull out of Chinese markets, they often look to other places to park their money. This could cause fluctuations in US markets, especially in industries like tech and manufacturing that rely heavily on Chinese trade. And let's not forget about the stock market. If China's stimulus fails and their economy falters, it could lead to a broader sell-off in global markets. If you have a 401k or are invested in the stock market, that could mean losses on your investments. So, how does this all hit you personally? Let's break it down. First, there's the direct impact on prices for goods and services. A faltering Chinese economy could disrupt supply chains, causing price spikes on imported goods. That's higher costs for the stuff you buy every day, whether it's a new phone, clothing, or even appliances. Second, if you're an investor, pay attention to the markets. China's instability could shake things up. Now is a good time to review your portfolio. Are you overexposed to industries that rely heavily on Chinese trade or manufacturing? Diversifying could help manage risk. Lastly, be prepared for market volatility. Even if you're not an active investor, your retirement accounts, mutual funds, or even the broader economy can be affected by what happens in China. Keep an eye on developments and be cautious with financial decisions in the coming months. So to wrap it all up, China's stimulus package, while designed to boost growth, might actually be a signal of deeper issues. Instead of the usual market rally, we could be facing a downturn, and that could affect all of us, whether through higher prices, market instability, or supply chain disruptions. Thanks for sticking with me through this deep dive into China's economy and its global impact. If you found this video helpful, make sure to give it a thumbs up and hit that subscribe button so you don't miss out on more financial insights. I'd also love to hear your thoughts. What do you think about China's stimulus package? Do you think it will eventually turn the economy around? Or could it be setting us up for a global downturn? Let me know in the comments below, whether you've got a financial perspective or just some thoughts on how this could impact you personally. I'm eager to hear what you have to say. Stay informed, stay prepared, and I'll catch you in the next one.
I bet you didn't know managing money could be this easy. Subscribe now and get the latest finance tips and tricks straight to your feed. From saving smarter to investing better, we've got you covered. Don't miss out. Hit that subscribe button today.